5 Stock Market Strategies for Beginners. Here are 5 investing strategies beginners can use to get more involved in the stock market. After an employer-sponsored retirement plan, the next stop for any stock market strategy is to invest in other tax-advantaged accounts, such as a traditional or Roth individual retirement account. You can open an IRA at an online broker. Many brokerages don't require an account minimum, and you won't be investing any of your money until you're ready to do so. The major difference is that with brokers, you'll have access to the stock market when you're ready to invest. And if you max an IRA out for the year, you can always continue investing in a taxable brokerage account. These are also opened at an online broker, but they don't offer the tax perks of an IRA. One big drawback of traditional and Roth IRAs: there can be penalties and tax ramifications if you withdraw funds before the age of 59.5. Roth IRAs are more forgiving on early withdrawals. You can pull out contributions at any time, but you may be penalized or taxed if you pull out investment earnings early. But that restriction might be okay because there's a key rule of thumb to keep in mind with any stock market strategy: don't invest cash you'll need within 5 years. Patience pays when investing. You need to give your assets time to weather the market's ups and downs. A key rule of thumb to keep in mind with any stock market strategy: don't invest cash you'll need within 5 years. If 59.5 feels too far away, a taxable brokerage account won't penalize early withdrawals, but it also won't offer the tax advantages of an IRA or employer-sponsored account. Most brokers offer both taxable and tax-advantaged accounts. Opening a taxable brokerage account may be the next step if you're already maxing out a 401k and an IRA, and you have idle cash sitting in your bank account. However, the following strategies can be applied to both retirement and brokerage accounts. Advertisement: NerdWallet rating. NerdWallet's ratings are determined by our editorial team, and these funds are built on passive management strategies. Passive investing seeks only to match wider market gains, as opposed to active investing that tries to outperform the market by frequently buying and selling stocks. In other words, if you'd invested in a low-cost index fund that closely tracks the S&P 500, there's a good chance you would have seen better returns than in the average mutual fund. This cost difference has sparked a growing array of robo-advisors that automate portfolio management, which allows these companies to charge much lower fees than actively managed accounts. If you want to buy stocks, try to keep these to 10% or less of your total investment portfolio. Again, actively managed stock market strategies that seek to beat the market regularly underperform passive strategies. A better strategy, experts say, is to make new investments at regular intervals, a process known as dollar cost averaging.